Verma, India Chief Economist with Nomura joins us. Sonal, good morning. Thank you for joining us. The optimistic in me is prompting me to ignore the rate hike and focus on the growth commentary. Is that the right way of looking at yesterday's policy?
Well, everybody is going to look at and analyze the policy from a different perspective. I think, clearly the macro setting has changed. We've moved forward now to a macro environment where domestically both growth and inflation numbers are picking up for sure. And even on the global front, there are certain risks which have emerged, whether it's from higher oil prices or the fact that dollar has been a bit stronger, which has led to capital outflows from some of the emerging markets. US yields have moved higher. So both the domestic as well as the global macro environment has changed. And I think that's what the monetary policy yesterday acknowledged by hiking the repo rate.
But what is the outside chance, Sonal? Because equity markets are already pricing in that yesterday was not it. There are going to be several, perhaps 2 or 3 more rate hikes coming in. Do you think that's the right approach that one should take right now, that this is not it, maybe another 50 basis point hike is coming in the latter part of the year?
Well, our takeaway is that this is not it, that there will be some more tightening. Now, whether that's 25, 50, 75, it really sort of depends. One thing that did surprise us was the stance, which was kept at neutral. If the MPC wanted to signal what you are indicating, which is 50 or 75 basis point rate hikes, even after the hike delivered yesterday, then the stance should have changed to tightening. So actually, our interpretation is a bit different. The MPC, at least for now, does not see the need to signal that there are significant rate hikes actually coming in. They're a lot more data dependent. But yes, agree with you. And I think if the growth inflation numbers are headed higher in the next few months, which is our base case, then yes, this is not it. We do think that the RBI is going to follow through with another hike in August, beyond which it's going to be a function of whether the current growth cycle we are seeing sustains or not. Because, let's not forget, while the RBI has moved now, market interest rates moved higher much before the Reserve Bank, and therefore some tightening of financial conditions has happened. And of course, oil prices moving up for a consumer economy like India, it's a negative terms of trade shock. So how sustainable the growth cycle domestically is in India, and whether the global macro environment stays as it is right now, improves, worsens, I think those factors will determine the policy action beyond August.
Sonal, are you disappointed though that there wasn't much clarity in the commentary yesterday by the MPC on what they plan to do with liquidity? One was hoping that there would be some announcement coming in. How is it that you think the RBI is going to tackle the liquidity situation from here onwards?
Right. I think there was some expectation that given the rise in long-term bond yields, there would be some sort of a commitment on open market bond purchased. But to be fair, I think that's really a function of 2 primary factors. One is how the balance of payment position pans out, because unlike last year, India is going to run a very small balance of payment surplus, if at all. In fact, it could be a balance of payment deficit. So if there is FX intervention in terms of selling dollar, then the Reserve Bank actually may need to inject more INR liquidity. And second, the increase in currency in circulation has been quite substantial in the last 1 year. And post August, September, we will again see significant currency outflow from the banking system. So both these factors, the currency leakage as well as the balance of payment position, in any case suggest that banking system liquidity will move into a deficit, which is sort of a permanent liquidity getting into a deficit, and therefore some amount of OMO buyback will need to be done by the Reserve Bank of India to ensure, what they mentioned yesterday, which is that the weighted average call rate remains close to the policy rate. So although the commitment did not come yesterday, which I guess is what disappointed market, but effectively, given the macro dynamics, we do think that OMO buyback will happen in the second half of FY19.
How much do you think, Sonal, would, 2 rate hikes or maybe 3 as the market is opining right now, could impact the revival in investment demand-led growth, which, the government has been banking on for a while, and draw a correlation because, one is still not clear how sensitive that demand revival in loans is to a tightening cycle.
I mean, I think, that's a fair point. And, even if you look at the breakup of credit, it's not that industrial credit is picking up. A lot of the increase we've seen is really on the retail side. So the, higher interest rates, in effect, to an extent, what they will do is essentially try to curb down this part of consumption demand, which to an extent you could argue is being driven through increased credit expansion. So I think there might be more of an impact on that front in terms of retail side. And on the private investment side, I think at this stage, given the balance sheet situation, neither, were rate cuts going to significantly revive private investments, nor will rate hikes, lead to delay, in the same vein, because the focus is very different. The focus is on balance sheet deleveraging right now. So for me, I think the channel of impact is primarily on the consumption side to an extent, and second, it's more from the signaling perspective. But I think more than the policy rate, I think clearly the fact that market interest rates have moved up, I think is a lot more important. And that in effect does mean that the cyclical recovery that we are seeing right now at some point in time will start to get, deflated to an extent.
Bond fund managers we've spoken to yesterday and today, they are of the view that look at the 1 year and the 10 year and look at the spreads there, the long end of the curve and the short end of the curve, and the differential clearly seems to be indicating that the bond market are pricing in not 1 but 3 rate hikes.
Right.
So So my question to you is that in this case, is Reserve Bank of India really way behind the curve? Because it's like Fed, the US bond rates are at the Fed rates are at 1.75 and the 10-year paper in America has already moved to 2.8, 2.9%. So do you think in this case we should not get fixated by the future course of Reserve Bank of India rate action?
Right. No, I think, the fact is, it is obviously about domestic inflation, but there are so many other factors that are also driving the bond market, right? I mean, whether it's the global oil prices, it's the US long-term interest rates, or the fact that participation from local public sector banks has been a lot more muted. And so, the increase in the risk-free rate, for instance, which is sort of the benchmark for, from which the pricing happens on most other instruments, has to be seen in the context of not just, whether the central bank is ahead or behind the curve, but also the other dynamics that have changed.
An average viewer tuning in, yesterday it was really about this historic rate hike, first time in over 4 years. What does it mean for different segments of the economy that are dependent on the pricing of loans, whether it's housing finance, whether it's the auto business? How does this really flow through in terms of, nurturing productivity gains that we've been seeing thus far? So like you said, this is really about the RBI's endorsement that growth is coming back and we are encouraged by the data we've seen out there. But how sustainable are those numbers? Because world over, one is still grappling with, the sensitivity that there is to the sustainability of that trend.
I think, of course, what the Reserve Bank does is very important from a signaling perspective, but the bank response obviously is also a function of their own liquidity dynamics. And given the incremental credit deposit ratio and the gap we are seeing there, banking system liquidity has tightened. And therefore, irrespective of the RBI action, we did see banks raise their deposit rates, and therefore, in effect, their lending rates have gone up. So I think, the outlook for the broader segments that borrow is going to be a function of liquidity dynamics of the banking system and the RBI action. And at this stage, yes, both do point to the same direction, which is that incrementally there will be some increase, in interest rates from the borrower's perspective. Now, I think what is quite intriguing is that within 6 months of an economic recovery, we've seen a significant buildup in inflation pressure in India at a time when the balance sheet is clearly quite stressed. And, we do think it's sort of a signal that perhaps the potential capacity of this economy has come off, which is why we are seeing inflation pick up so quickly in the economic recovery cycle. So if the central bank has a mandate of 4% inflation and the capacity of the economy is not to grow beyond a certain level, then only way to really bring inflation back to the target would to ensure, that growth stays close to potential rather than above potential, i.e. The objective of monetary policy tightening now at this stage is to, sort of fizzle out some of the cyclical recovery. So, to your question, I think in the very near term, let's not forget monetary policy works with huge lags. So in the very near term, the growth numbers will continue to be very strong. And we do think that in the June quarter, we will see a repeat of a growth number in the 7.5% to 8% range. But given that, financial conditions are tightening, and like I said, higher oil prices is negative, it does sort of imply to us that we will see some slowdown on economic activity in the second half of FY19.
So we leave it at that. Thanks very much for taking out the time and giving our viewers the perspective that they require right now to understand this historic rate decision that's come in. It's come in after 4.5 years, and it's come in with a neutral stance, which is typically and traditionally not been the case as far as RBI commentary goes on policy action. But thanks very much once again for taking out the time. We'll take a break.